Hello and welcome to today's episode of Nucleus Investment Insights. Today we're going to talk about the cracks that are starting to appear in the Australian property market. On the agenda, we'll discuss the pressures that are ramping up on borrowers. We'll have a look at the tax office collections and director penalty notices, which can be a canary in the coal mine. We'll investigate the rise of incomplete property scenarios. Next, we'll look at the last few years of liquidity and cheap money, which encouraged investors to take larger risks and how that's unwinding. Then we'll talk about troubles in development lending. And as always, at the end, we'll discuss the investment implications. Today, we're joined by the CEO and CIO from Oak Capital. Oak Capital is an alternative bank, non-bank lender and credit fund, which is well placed to understand what's going on at the coalface of the property market. So it's my pleasure to introduce Stephen Mitchell, who's the founder and CEO of Oak Capital. Stephen, welcome.
Thank you, Sam. Thanks for having us. Thank you, Damien.
Absolute pleasure. It's your third appearance on the podcast, so it's great to have you back.
Thank you very much. Good to be here.
Next one's free.
Next one's free. Get a free coffee.
And I'd also like to extend a warm welcome to Troy Stratton, Oak Capital's Chief Investment Officer, who has a diverse background in finance across Australia and the UK. Troy, welcome.
Thanks very much, Sam. It's very good to be here, and I look forward to that free coffee in the next third episode.
Absolute pleasure. As always, we have Damien Klassen, who's Nucleus Wealth's co-founder and Chief Investment Officer. Damien, welcome.
Thanks, Sam.
My name's Sam Kerr, and I'm the senior financial advisor at Nucleus Wealth, and I'll be the host of the show for today. Just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. We are live every Thursday at 12:30 Melbourne time, so jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show's available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon. And you can view these at nucleuswealth.com/webinars. So now we've got those formalities out of the way, we'll get started. So Damo, I'll hand it over to you, get the ball rolling.
Yeah, thanks, Sam. Look, we've got the guys in today because we want to really get a feel for what's going on at the coalface. So we've spoken in the past about interest rates taking sort of 2 to 3 months, even just to affect people's bank accounts. And then from there, it takes a little bit of time for people to actually feel the pain. I think a lot of people live on the basis of when my bank account's empty, that's when I stop spending. And so, you might not even notice the interest rate rises for a month or two until you start noticing, hey, my credit card bill is a bit bigger than what it used to be. And then you actually get that second order effect of companies start to lay off staff or things like that. And so that can take, a year to actually come through. The RBA has been raising rates faster than they've ever done before. And so what we're trying to do is really get a feel for what's really happening right at the tip. And so that's where we sort of brought the guys in to discuss. So maybe we start on the easier part. Maybe we start at the lending side. The actual investing side. So I think post COVID, there was the thought that there's a lot of money sloshing around. Mm-hmm. There's probably less focus, I suppose, on investing directly in property at the moment, and more people just trying to get yield themselves and take advantage of the 5 or 6% you can get. So how are you seeing that from the investing front?
Yeah, so from the investing side of things, you're very right. The investors are looking for a reliable source of income. Now, with the volatility that's happened in the market, we know what happened in March 2020. Obviously, COVID happened as well. That uncertainty is causing a lot of investors to seek something that's a little bit more stable, a little bit more regular on their income sources. Mm-hmm. And we're finding that both in the retail and the wholesale market, that's exactly the same underlying message. Yeah. The retail market, a lot of investors coming to us saying, we want to be investing in property. We believe in the asset, but I don't want to go up the scale.
Well, somebody else owns it, and I'm just taking it.
Right. And there's a lot of people who are sitting there going, property. I don't know anyone who doesn't have a dinner party that talks about property, right? It's ingrained in our culture, and everyone knows it, whether you want to buy it, whether you want to live in it, or whether you dream about owning something that's on Beach Road, right? And the investors therefore have a tangible connection with property. And for our side of things, when they're speaking to us, they're looking for reliable yield, but not too high. So there's that tipping point, right? There's that tipping point where investors will be, that yield is too good to be true, and that's correct. Like there are organizations out there offering yield that's not suitable to the risk that investors are taking. And so we find our investors are very conservative, and they want to make sure that they protect their money because they've earned very hard in times to get it.
Yeah, and so I guess relative to ordinary times, the spread between what you, I guess one of the thing is there's a spread obviously between what the RBA is doing and what you guys lend at, and in times of trouble, that tends to blow out as all the lenders start going, just a minute, I need to put extra pad in. I'm assuming that, and I guess there's a push-pull, isn't there? There's the one part is I'm worried we've had all these interest rate increases, and maybe the guy I'm lending money to can't actually handle 7% interest rate. And then the other side is there's so many people out there trying to give me money, and they all want to just find a home, and so it sort of pushes down. Are you finding there's enough investors that sort of overcomes that rise in rates, or not?
Yeah. We continue to see a heightened level of demand for our services and for our products, and we're finding a lot of our investors are looking to place their money for a shorter period of time because that uncertainty is happening.
When you say shorter, how?
Well, so our loans are anywhere between 3 and kind of 18 months. Yeah. And so when someone comes to us,
sorry, and to put that in perspective, that's usually people who are business owner, cash flow issues.
Yes.
Bridging.
Yeah. And so our lending solution is to the small business owners. It is to help them either through their cash flow requirements that's secured through property. Yeah. And so we're there to help service their needs and their lifestyles and how they work on their financial or their investment requirements. And so that shorter term investment, i.e. anywhere up to about 12 months, is what we're finding our investors are finding the most appealing.
In regards to that spread issue, we have actually found over the last 2 years, although the RBA has now gone up, but if we talk pre-RBA movement, our pricing came down, right? Yeah. So our pricing point now compared to, say, a large second tier like a Latrobe is actually a lot closer than it's ever been. Right, and we are moving pretty much up alongside the RBA type movements, mainly because there's been so much liquidity and there's so much more competition in our space than there ever has been. Yeah. So we used to speak, and I think last time I was on podcast about there was a lot of new lenders that were starting up, and it only exploded more through COVID. So you had a lot of investors with capital that wanted to get out the door, and a lot of some unsophisticated, some sophisticated lenders were structured and set up, and you're constantly battling against that. And the one thing we don't want to change is our risk appetite. We haven't gone down the line of large-scale development lending, and we're not increasing our RBRs. If anything, we pull them back. So the only thing that gives, if you want deals, is you have to adjust your rates, right? There's a lot of competition in that space. So it's made it a much healthier sort of market, arguably, because a lot more lenders involved. But we believe, see in 23, 24, a lot of pressure come down on those other lenders that may have gone a little bit hard in order to get some market share.
Yeah. Well, and I guess this is the question about, let's say defaults spiked up. I guess what it sounds like it's saying is there's probably a reasonable amount of people out there who haven't left enough fat in their books to actually better handle high levels of default. Yeah, so
I think like anything, there's always good operators, and then there's others that exist. Yeah. We've always been really a 2/3 type lender. Yeah. And given we have a shorter tenure, so 66% or less, right? So against the value of the property. So you've always got a third equity. Yeah. That's generally been the old school model of sort of private lending. Yeah. And then you've got other people that have obviously taken on other types of risk, being development or high LVRs. And we noticed during actually the start of COVID, very interestingly, given there was so much liquidity, a number of our defaulted loans that we had on our book at the time actually refinanced off our book. So we basically paused lending to look at the market, go, oh, let's see what happens here. And then we had all this runoff. But the runoff was actually our higher LVR defaulted loans that we were actively progressing. But new lenders were coming and going, oh, we just want loans. They've taken these loans off. Now, if you look at those loans that they took off us on the assumption they probably defaulted again, with a market that's cooling, there is no fat left in order to recover that transaction.
Well, and I guess that's where that's where I was leading with the next question is, it's one thing to say, okay, in mid 2020 or late 2020, I'm defaulting on my loan. you know, I'm switching you to somebody else, but back my property value has just gone up by 10%.
Yeah,
so
correct.
now I can sell it and everyone's happy and walk away or, you know, or refinance.
Yep.
But yeah, the question is when it starts going. So in terms of the stuff you're seeing, you get different answers from depending upon who you want to use as your property source. I'm assuming.
So look, we're being a conservative fund, so we naturally in our retail space we use certified valuers, and we only use certified valuers that basically write deals for the right valuations for the major banks, major lenders.
Yeah.
So we don't accept you know just the random value that the broker puts up, which a lot of people do.
Yeah.
A lot of lenders actually have got their brand out there that they will literally, their brand is "we will use your val," which we find quite amazing. So we only use the major firms such as PRP, Altium, Charter Keck, all those sorts of groups.
Yeah.
So you can have a lot of confidence in that. But our biggest differentiator is we have employee valuers ourselves internally, CPV values and RPV values. And they also spot check those vals and do our valuations a lot of time for our wholesale investors. So we have a good gauge on the property space that we're lending on, and where we look at those numbers and make sure they add up. And one thing that's happening in a downward market is it's well and good to do a valuation today and use comparables from 6 months ago. But the comparables aren't accurate here, right? Because the market has moved. So the one biggest thing that our guys do internally is they're speaking to those agents. And if you speak to an agent from a $2 million comparable 6 months ago, he might say, it's not worth $2 million now. I'd only get 1.8 now. So that's your comparable. It's not 2. Now, broad scale valuations that are done, they're not calling agents, right? So we always use that as our view. And, you know, one of the biggest wins that we have for our investors is that we are using today's numbers as best we possibly can to get an accurate number, and then lending a conservative lend on that. The other thing we've seen based on those val numbers is a lot more high LVR requests. There's a clear difference today than what we had 12 months ago. Is far more applications and requests are coming through, pushing the LVR request up. Now, people's values are coming down, they're already realising it, and the debt level's still the same. So the LVR request on average used to be probably across all scenarios, say 65. Now you're getting a lot more 70s and 75s. Now we completely cap out at 70 and do seldom amounts of those. But other people are coming in still writing 75 and 80s, which we find.
But so I mean, obviously these things move in cycles. I guess I'd sort of say, well, say, you know, pre-2008, obviously it was all, you know, all hands on deck and whatever you wanted to, you know, it was a race at the bottom in terms of lending standards. And so that sort of obviously blew up a lot. I'd say pre the Royal Commission, it seemed as if it was going a similar way. And then the Royal Commission sort of came and it felt like everyone sort of pulled everything back. In terms of, so I don't know, we call the pre-GFC a 9 or a 10, and we call pre the Royal Commission maybe an 8-ish. I don't know, is that where would you see that?
I don't think the market got back to anywhere near what it was pre-GFC. Pre-GFC is pretty interesting lending.
More like a 6.
I don't think it's been that bad. It's quite, you know, it's heavily regulated now. And even in our space, you know, we only lend in a non-regulated market. But still, the DD that we do on our deals and that our competitors do that are of reputable status is quite detailed. Right?
Sorry, I guess I want to make it clear. I'm not trying to cast aspersions. I know you guys are doing one end, but there's obviously sometimes you're like, oh, there's a couple of cowboys out there, but not many. And other times you're like, man, there are a lot of cowboys out there. And so, in terms of how, you know, in terms of that, how would you see the number of ones where you go?
Yeah, I think there's a lot of smaller cowboys out there, but small can still have 50 million that they're managing quite comfortably, and there's a lot of them that can hurt. Generally, the bigger players are still doing most things right, or at least have their views as to why they do the lending that they do. I don't think the market's as full of the real old school shady private lenders that it used to be. But, you know, they're still around. But there's so much competition now that those guys are probably falling way more than anything else. It's more how aggressive and how quick the new guys want to go. If they want to grow their books rapidly, then dial down your rates, boost your LVRs, and take on some other types of lending. And they can still be a reputable lender, but they're arguably pushing the boundaries on the lending. And that's okay to do if the property market does that. But it doesn't always go up.
No, exactly. And so Yeah. Okay. So in terms of I guess what it sounds like is relative to sort of an ordinary market, you've got a few concerns, but you're not sort of saying this is, it's a house of cards ready to, you need a reasonably sized housing market continue to pull back to actually cause some major problems.
That's correct.
Yeah.
I agree with that. I think there's going to be pockets.
Yeah.
I think, as we all know, with builders and development, there's been a lot of issues, especially with big scale builders.
Yeah. I definitely want to spend a whole
we'll wait for that one. So I think there's markets within markets, but I think in general, the Australian property market is extremely solid. Will it cool? Yes, it is. And we can see that now. We're seeing that on applications. We're seeing that on clients that are selling assets. They're coming in under. Yeah. But you would need a sizable correction. Yeah. Which, fundamentals just arguably don't hold up for.
Yeah. Now, anecdotally, I'd heard from a number of sources that there's a lot of brokers who are sort of going, somebody turns up and goes, oh, my 2 years just about finished. And they're like, well, yeah, you jump into whatever, X% above that. Yep. And your payment's about to go up. But I tell you what, why don't we extend you from 15 years to 25 again, and we'll keep your payments low? Is that am I just hearing anecdotes, or is that something I guess you think might be happening in terms of the extensions? Or
if Troy's got a view, my view would be every broker will be as creative as they can to get a deal done. Yeah. And I don't think it'll just be on fixed rates jumping. That's going to be on anyone that previously might have been applying for a 20-25 year mortgage. Yeah. But the serviceability changes now. Yes. Is forcing them to apply for a 30-year mortgage. So it wouldn't shock me that a broker is saying, well, in order to soften the pain of you going to a 15-year PI facility, let's move you to a 30-year and try and drag it out. No, it's a logical thing to do. Yeah. But it doesn't surprise me that they've still got the same amount of debt. It's going to carry for longer.
Well, yeah, but and I guess I'm thinking about this from a macro perspective. I guess I'm thinking, well, the fact that somebody's still got the same amount of debt, but their payments haven't jumped a lot. Well, okay, they're going to be buying coffees and going out and all that type of stuff versus going, shit, I got drink my coffee at home, not going out anymore. I'll get a Netflix and that'll be my entertainment. And so that's where I guess the danger for me, it's when we're starting to see that discretionary spend really get hit. Yep. And that's where I'm just really not quite sure whether, if you guys had turned up and said, oh yeah, we're seeing people in pain everywhere. Yeah. Okay, that's confirming what I think is going to happen, but maybe we're not quite there yet.
I don't think we're there yet. Yeah. But I think Troy's got some views on it.
Yeah, and the irony is what we've noticed is spending habits of individuals reflective of what they're seeing in the market. So if we have the RBA's purpose, which was to increase rates, that's trying to taper the spending because we've been relatively insulated in relation to our costs. Our costs on our groceries have gone up largely because of the floods and everything else that's happening. Yep. Our energy prices are going up, but nothing like what's going up over in Europe because of what's happening in the hurricane. So we're a little protected on that side of things. I think the test really is when someone goes out to buy something that they used to buy, and let's just say, I don't know, a hamburger test that the US tend to do. Yeah. If they go out and buy a hamburger and the hamburger is now all of a sudden $15 and it used to be $10, they'll be like, oh, okay, that's a bit of a shock. Yeah. I don't think anyone's seeing that right now. Everyone in the cafes, I don't know what you guys like. I go to a cafe and I have to queue up to go inside on a Saturday or Sunday morning, right? Yeah. And when we see those habits, you'll see the change of people going, okay, now we'll tighten up, and that'll be the conservative view they'll have on lending, because lending tends to be a protected space, right? So most people will sit there and go, do I want to lose my house or do I just want to defer my credit card? Yeah. And most people will tend to repay their loan because that's what we've kind of been brought in to do. Paying a credit card can be deferred. You swap your credit card around, so many offerings around that. So we're noticing that even if you're looking at the kind of the consumer spend, and the RBA is releasing a lot of those results on a monthly basis now, it'll allow investors and your audience to see, is that starting to taper? Because if that continues on the current trajectory, the spending habits aren't going to change. Yeah. But I think now, once the mortgage rates, as what Stephen's saying, is going to hit the bottom pocket, the bottom line of businesses, where people are starting to realize, actually, you know what, 6 months ago I wasn't feeling it, but now I'm redoing my budgets and I'm actually looking at what I've got to do for the next 12 months, and we just can't afford that anymore. When you see that change, I think that'll be reflective of spending habits. But what we're noticing is it doesn't necessarily translate to defaults, or it doesn't translate to a concern around payments of people's mortgage repayments, because most people tend to honour that. And you would have seen that throughout the whole COVID as well.
Yep.
Banks spent an enormous amount of time through hardship, making sure everyone was comfortable and everyone was serviced, that there was a bit of a backlog, right? Everyone was able to defer it, the moratoriums on rentals, all of those type of things were helping the actual, the mums and dads and everyone who's got a property. What that's done is it's kind of like allowed for someone to have a piggy bank on the side. That I think what's happening is we're seeing people eroding their savings at the moment that they've built up over a period of time.
Yeah.
And then obviously when that tipping point happens, or offsets, precisely, right? I think that the RBA identified something like 200 billion is sitting in offsets. That's an enormous kind of buffer for everyone to be able to afford on. And knowing that you have that to draw down upon, I think everyone will be like, oh, that's okay, I'll just pull it from the offset. And that's just kind of almost free money for everyone, right?
Yeah.
There will be a point where someone goes, I don't want to do that anymore, and I'll change my spending habits.
Yeah.
And of course, the macro effect to that.
Mm.
So stop spending,
oh,
then the businesses go, and then the jobs go, and everything else. So
yeah, that's the point I'm trying.
I think we're good at the moment, but I think the reality is, I think 2023 is going to, things are going to start to bubble, and as soon as people start losing their jobs or the cost is going up, they can't afford it, and that buffer is gone, then something's got to give. Mm. And we have been using, be it the moratoriums on mortgages, moratoriums on your commercial lease repayments, and of course the ATO. They've all been used as a bank, but those banks are now saying no more. Yeah. So we're going to see that be a problem. You've got to start, when you start forking out money to places that you for last year didn't have to. Again, all these things add up.
Well, and we've just gone to obviously quarterly payments of POYGs and everything to monthly payments, and so I feel as if it's too early yet to really be feeling for people, but I feel as if that's it's a bring forward for a lot of people. So I might have had a whatever it is $100,000 expense or $200,000 expense that I only had to pay once a quarter, and it was almost like working capital for me, and now I've got to pay it. 60 grand a month. Actually, that's I'm going to bring forward $120,000 that I didn't. I could have waited for 2 months, and so that's got to come from somewhere.
And businesses on the edge never seem to save that money, right?
No,
so it's never squirreled away in the GST pot or something else. They find it last minute to pay it, and once you start putting extra demands on people up front, it does start to be hard.
Yeah. So that was where it was leading. So it sort of leads into commercial stuff. The bit that always fascinates me, and I don't know if I'm looking at this the wrong way. I sort of look, let's say Melbourne City, and I think it's still the same in Brisbane or Sydney or whatever. But I look at Melbourne City and I go, right, there's sort of one end of the city, the sort of western end, where it seems like one in 3 or 1 in 4 shops actually has somebody in it, and the rest are all vacant. You go up to the eastern end where more people live, and it's a bit better up there. And then you go into the sort of suburban areas, and if it's a reasonable strip shop, they're all full. If it's halfway not, they're all empty, or maybe one's actually got it. And it feels to me as if, somebody owns these things. Maybe during COVID and everything, when the person they're renting to gave up and moved out, they're like, oh, this is terrible. But actually, I've just cut my interest rate, and property values just went up. I just gave up 50 grand, but I just spent 100 on the capital value, so who cares? I'll hold it. Whereas now it feels as if, that's turning the other way. When does that actually become an issue, or is this just going to run people? Because generally, I'm guessing they're richer people, and it's just going to run down the savings.
Yeah, I've had an interesting view on this for some time. Yeah. Just given the commercial vacancies and that throughout the city, and the incentives that are given back on commercial tenancies, I always find it incredible that you can go through COVID and the vacancy rates that went through the roof, and the incentives that have gone through the roof on commercial property, yet the underlying value of the asset apparently goes up. Yeah. Right? Now, I find the creative accounting that goes into those valuations amazing, especially if you're a property fund or something else.
Yeah, let me put that in perspective with our own lease. Like the people who we're leasing from basically they gave us 50% discount, but they were very specific. We're not giving you a 50% discount.
Not on the rent.
You're paying the full amount. You're just paying it every second month rather than every month. Yeah. And they're like, no, that's the number. Don't forget it.
Because they only then show that rental rate to the valuer.
Exactly.
Which we've always found that to be quite odd. And, a few of us at Oak have always reviewed that. And then, you speak to different financial advisors in the market. And, some people love investing in property trusts and all this. And, when they own city assets, my initial view was, oh, well, they must be hurting. Yeah. But no, apparently they're all going great. So I find that interesting. But look, we have always been quite, well, especially since COVID, but being very conservative on city-based things.
Yeah.
Strip shop stuff, especially retail, you have to be more conservative. It is such an ebbs and flows sort of market, right? But I agree with you. At prime strip shops, they are flat out. If you go to a strip shop out in Brighton Way, flat out constantly. But then you go to the more dingy sort of areas, different strip shops, and they are dying. And look at Chapel Street. Right? Every third shop is for lease. It's really, really sad. But do you want to be a property owner there? Like the values are very, very difficult.
So if I'm on Sydney Road or Chapel Street and I turn up and say, hey, I've got this great property, can you lend me 65% on it?
We won't be lending 65. So we may lend 55 to 60. The catch is what's it worth?
Yeah.
So 55 to 60 of our value.
Right.
Of reality,
yeah.
Not 55 to 60 of what you think it's worth.
Yeah.
So there's always going to be inherent value there, right? The market will turn, and those areas will get busier again at some point, and all those sorts of things. Yeah. And there's still someone that will always buy something at the right price. There's always going to be an investor hanging out to buy something at the right price. Yeah. It's just being not getting caught up on the hype when you're looking at your valuation number. You've got to look at the reality.
Yeah.
And especially some commercial properties have got amazing leases on it because they're legacy leases. Yeah. So when you look at the val, you can't just value it on that. You've got to look, well, what would that release for today? Because if that tenant walks and we have to release it and it comes down 20%, your val is going to be heavily affected. So when we're looking at a very realistic, what if this is a worst case scenario number, not because our investors don't get a yield based on the upside of your property. Our goal is to secure and protect their money. That's the way we've got to look at our vals, not on the how do we punch out the highest number for this asset.
Yeah. And so, what do you think is going to happen, say, to, sort of, let's say West End of Melbourne, say, as an example, in terms of, if I owned a shop there, like, what's my, am I just,
you should have sold it more.
Yeah, exactly. But it's just, when do you actually start seeing these things leased? Like, because it feels as if there's this tension between people like, well, I could lease it at half my rate, but I don't want to do that because all of a sudden then my value comes down. And so I just sit back and like, is that what we're
and that theory always goes with some great real estate agents that give terrible advice to landlords. It's no different to you want to pass on a $10 rate increase on your residential house to your tenant, but they might leave. If they leave and it takes you 2 more months to rent it out, you may as well just kept your rent the way it was. But of course, it's not in the real estate agent's interest because he wants his leasing fee. So the same sort of thing goes. When's the right time to sell? I guess it depends on, can you afford to hold and what else can you put your money into? But it's going to take a long time for this city, especially Melbourne, to recover. I find Sydney's very different. Sydney is buzzing along at a different rate and their occupancy rates are different to Melbourne. And you feel it. If you go to Sydney, it feels busy. Melbourne feels dead. And if you're down in Docklands, it's beyond dead. And how long is that going to take to turn? It's going to take a hell of a long time. And it starts with the government. It starts with the government changing the work from home policies and getting people back into the city. And I'm hopeful that will start to occur after the election, but we'll see.
You must work from home. You must work from the city.
I think something has to happen because it's one great way to kill a city. You have everyone not here 2-3 days a week.
And we were working through obviously COVID, and we were supporting all the local businesses. And one of the kind of stories I bring up with everyone is we sat down and we spoke to a coffee shop owner. And during COVID, it was like, I'm doing 400 a day, but in the midst of it, he was doing like 5 or 6. And we as a society need to be able to help support the small businesses because they are the backbone of our whole country, right? And we need to help bring everyone back into the city, help them all support what they're going to do. And I'm not saying we don't give up what's out in the suburbs. You can't go one versus the other. But I know there are people who have built their livelihood on going to where the large populace of people are. And creating good businesses around that, which creates good asset change. Yes, right. Now you've got a shift on it all. So shift is now going out to the suburbs where coffee shops, which might have been a little bit more quieter on the Monday to Friday, but rampant on the weekend, are a little bit more buoyant during the week, right? And that's great for them. I think that's really good for the whole industry. But for us, when we see, when you're walking around the shops here and you're seeing for lease, you can't help but feel for the people who have those businesses and how can we as a society help them?
Well, but there's a question as well about this. You feel for the people who had the leases, but maybe there's somebody who had the lease and was like, okay, I'm getting charged 50 grand a year. I can't handle it anymore. And then the owners go, no, I'm not dropping 1 cent. And now sitting for lease for 2 years. Is it like, well, this guy needs to drop his rent, but he won't do it.
Well, that's the Chapel Street issue. Right? You've got so many landlords there, and generally the same one across multiple assets. They're just not willing. And if it's, I guess it's all well and good to be not willing when it starts to go. The problem is once numerous ones go, no one wants to beat it. So it's very hard to play catch up.
Yes, it sounds as if, I guess where I'm getting to this, it sounds as if we still have this issue about things are probably fine until one day when all of a sudden a collective that goes, hey, things aren't fine, and we all of a sudden have this rush of landlords go, I'm either selling it or I'm cutting my lease by 50% to get somebody in there. And
and we've still got investors who are interested in commercial property too. So we will have them specifically say, I would like to have a commercial investment, and we're like, okay, here we've got on what we have on our books. Now they're realizing it because they are also commercial investors themselves. They own property themselves, and they know that it's a long game. Right. A lot of people get caught up in the fluctuations of the prices over a period of time, but they play the long game, and they realize that if it's a good structural sound asset with good tenants, then that can go on for many, many years. And they feel it.
Now it feels as if the stuff I'm reading anyway is that in the cities there's a flock to A grade buildings and at the expense of the B and the C's. And that's where most of the, I'm not sure what the vacancy rates are, but they're probably triple or quadruple in the B's and C's is what they are in the A's. Is that are we waiting for structural change and everyone decides, now it's time to come back to the office, or do we need structural change in terms of we're going to start converting these into residential? What's your sort of take on the B's and C's?
I think if you break it down quite simply, before COVID, the vacancy rate was an issue, right? Because everyone's here. So the only thing that's changed is the work from home. So the question is going to be, how long does that last, and at what does it look like as a long term? It's always going to exist. But I don't personally know many business owners that like it. And everyone is moving on it because they can't. Unemployment rate is so low, it's so hard to get staff. So if you're a new staff member that you try and employ says, hey, I want this wage and I want to work from home 3 days a week, a lot of businesses are going, okay, because I can't get anyone else. When that tide changes, which it will, and it's easier to employ staff again, I think you'll find that a lot of businesses will start to demand their staff to come back into the office, at least for a larger portion of their time, unless they're heavy tech-based businesses. That will then start to solve some of the problems. But you're going to be left with a lot of very average buildings who don't have landlords with the capacity to renovate, because that's one massive thing that a lot of them are doing now, is doing massive upgrades to really take it from a C to a B or a B to A minus. But like we're a prime example. We left a B grade building to go to an A because the incentives were so good. And even our building that we were in, the incumbent building couldn't offer the same. Right, but you're taking advantage of what you can in that exact market.
And I think there are businesses like ours who are also looking for real estate but couldn't find it because all the A's were being viewed by other businesses.
Right.
And so that creates an opportunity, or what I call an upgrade process, right? Where you've got someone in the D's and E's who want to come into the city, and they'll be like, actually, I might be able to afford it now because I'm able to have a refurb that's a little bit within my budget, and then for that person moves up to an A. And I know large banks are kind of like, many of them haven't even gone back into the office kind of thing, right? So you've got floors there that are empty, and I've got no doubt that those kind of owners are like, all right, what do we got to do it? And most of the banks are kind of, de-risking their book on their property. They're literally shutting down buildings because they don't need it anymore. But that creates a huge opportunity for other aspects to join.
It sounds like, well, I guess
there'll be a lot of leftovers that are going to have to be dealt with.
Right? We're talking about a decade or more to sort this out.
So people will convert, but then the question is, how many people want to live in those, right? What's the demand to live in the city in an ex office building that's been renovated? We still need to bring a lot more people in the country in order to satisfy that. So the whole range of issues.
I mean, you've obviously seen the little dog boxes that get rented out. I'm sure they can rent stuff out.
They will. We've got to get all those students. We've got to get a lot more things happening as well. There's so many elements to fix the problem that all have to come together.
Okay, development. So, actually, no. Sorry, I want to start first with the director notices.
DPN notices, director penalty notices.
So, okay. So, do you want to give a quick background on what we're talking about?
Yeah, sure. So, effectively, the ATO has a few, I guess, elements in its war chest in order to be able to collect debt. Now, so since April 2020, the ATO effectively put a pause on outbound debt collection. So they literally did not call any taxpayer that owed money to the ATO. During this time, the numbers go to about 50 to 56 billion worth of ATO debt now outstanding, collectible, what they deem collectible tax debt. So the number's up 77% in a couple of years. So a massive amount of ATO debt that's out there. Previously, if you have a company, the ATO would obviously try and discuss it with the director, chase up the outstanding bill. Otherwise, they'd then put you into a wind-up. Right? So they wind up the company, but any tax, or most portions of the tax that sat within that company can then literally be written off through a liquidation. Or you go into a negotiation and do a deed of company arrangement, and maybe pay 10 cents in the dollar to the tax office.
Yeah. And I'm right in saying most, am I right in saying most of these that actually end up in court, it's the tax office that's usually the driver?
So the ATO is the main driver for liquidations and wind-ups in the country, by a long shot. Now, naturally, they didn't do any. I think the data was for 2021. I think they bankrupted 3 or 4 people compared to the hundreds or thousands that they normally do, right? So there was zero movement. That movement is now starting. The federal election obviously went through, and now the ATO is chasing up debt, and the country needs them to. So they are using more than they ever have the tool of a director penalty notice, which the director receives a director penalty notice. If you don't deal with the DPN, there's 2 types, but if you don't deal with the DPN, you can then become personally liable for certain elements of the debt of the company.
Yeah.
So they've got smarter to pin you under that if you don't deal with that DPN, so that you can't just, oh, that's all right, I'll just liquidate my company and not pay the tax.
Yeah.
You will become personally liable. And the moment you become personally liable, then they can obviously go after everything that you own as well. So they can force a bankruptcy proceeding, which if you own your house, they can get to. Whereas previously it's always been an unsecured debt. So it's extremely critical that business owners that have tax debts deal with them before getting a DPN, or if you get one, to get onto it straight away with the right advice, because otherwise you will become liable, and they can ultimately look at getting into your assets, going from an unsecured debt, which is the ATO, to becoming a secured debt.
Yeah.
But they're issuing about 120 DPNs a day, right? So there's a lot.
Okay, right.
There's about 30,000 already been issued.
And when did this start?
Started this year, early this year.
Yeah, and do you think it's is this a ramping up to getting through the backlog, or are they just like, no, today's the day, we're back on 100%? I guess I'm saying, are they turning the volume up?
Yeah, I think the view is that they're just dialing up, and they're going after the most recalcitrant payers that they have. Not people that arguably have had new tax debt absorbed during COVID, but they haggled people that essentially were on plans that they didn't bother before April 2020, who have still not dealt with the tax debt that they owe. So people shouldn't be surprised though if they are getting these. And you'll even notice the terminology on the follow-up letters that people get, even on paying their quarterly PAYG. If you pay it, if you're a month late, you're getting a pretty nasty looking notice. Right? And you're going to be collected upon very quickly. So if you're a business owner who owes 100 grand and you're getting a notice 1 month later, it's a lot of pressure to deal with, and they don't know which way generally to turn. Banks won't help you out, and it can cause all sorts of problems. So we are now seeing a lot more loan applications that we get where a business owner has a portion of tax that they want to deal with.
Right.
Whereas we, for 2 years during COVID, didn't get any applications.
Right.
Whereas prior, it was always part of our general goings on as a business that paying out tax debt was part of it.
Yep.
Now we're seeing it again.
Right. And so let me just get this right, just in terms of timing. So the PAYG moving to monthly started this financial year, didn't it? So it started July. So it starts July, you needed to pay it in August. You got a threatening letter in September. Well, and arguably, maybe you can get through the first month or two, all right. But so we're actually starting to hit the phase now, though. We're actually only just getting there where it's like, okay, if you just didn't have that, if you had a $300,000 reported bill and you just relied on the fact that I can't pay 100,000 a month because I just don't have the spare 200 grand, I'll wait to the end of every quarter and then top up. Is that now you need to raise that 200,000, can't do it, and now you're chasing your tail and looking for tax debt. And but if the tax department was going to send you under because of that, we're 6 months away from that probably.
So yeah, it does take some time. So firstly, they do. To be fair to the ATO, they're actually very good. If you have a tax debt in your listing, just call them, right? Like most problems in the world, just pick up the phone and deal with it. They're actually very good at putting a payment plan into available for you. But if you don't deal with it, it's naturally when they do go harder. So it is weighted on the dollar amount that's owing before they're looking at DPNs. But they can also now lodge credit defaults as well, right? So they've got a lot more power. So generally, I think 6 to 9 months, and you'll be getting DPN.
Yeah, but I guess there's businesses out there that just don't have a viable. They don't have a viable business anymore.
Yes.
And you can avoid that for a long time because you've got all these payments and all this stuff like that. And now you're hitting the phase where I guess something has to, you're going back, but you're only going backwards slightly. Yeah. Something has to change for you to go, okay, that's it. I'm just going to give up. And often it's.
And this will be something, absolutely.
And so but what I'm saying is if there's a group of those companies out there, they've probably still got another 6 months before they actually genuinely start to hit.
Yep, correct. And that's true because we haven't seen the liquidation numbers or even the wind-ups of the administration numbers anywhere near what they were pre-GFC still. Yeah. They're creeping back up, but they're not where they were. So I think it's going to get in 2023.
And I think I was digging into the stats. I was actually writing something up for next week on that, and it seemed to me that the court-ordered ones are actually, that's the one that really hasn't recovered.
Yeah.
And so if you look at some of these other companies have, and that's, as I was expecting, I suspected most of it was tax department, but what it sounded like.
It's the biggest drive, but then the court appointments won't be there because they're issuing DPNs first.
Yes.
Because they want to make you liable before they wind you up. Right. Because that's actually extremely smart. Right? Why wind them up when people just go, you know what, I'm insolvent anyway, just dump the company, I'm not going to pay the tax now.
Yeah.
Instead they go, no, we're going to get you with this, so that then you do own it.
Yeah. And
you can't walk away from it.
Well, and arguably, though, as well, the way the tax department, for a lot of people, that was treated as that's my lender of last resort anyway.
Right.
If I'm running into trouble, I'll take a couple $100,000 from them first, and then if I'm still in trouble, well, now.
Correct. Yeah. So it's definitely an evolving space, but I think for business owners, they need to be mindful that you can do a deal with the ATO, you can about to speak to them, and they're very good at that, but you also need to find the capital. And there are solutions out there to find that capital.
Yeah. Okay. So that's defaults. Developers. So yes, well, let me throw it over to you first. Do you want to tell me what's going on in the development market from what you're seeing in terms of the
Hey guys, just quickly, we've had a few viewer questions come through. Quite a lot of stuff come through on the working from home. So Chris is saying he doesn't want to work in a city. It's crowded, busy, infrastructure is terrible. He's saying it's like the cabs crying about Uber. He doesn't think people are coming back in any time soon. And Okta, he's saying, he's asking, why does working from home hurt Melbourne so much more than Sydney? Have you guys got a view on that?
It's probably more a personal view. I think Melburnians got completely ruined during COVID a lot more than Sydney-sided. So people psychologically in Melbourne are a lot more affected than in Sydney. And Sydney never had that dramatic stay out of the office for as long as Melburnians did. And businesses here had to adapt even more than Sydney. So it's more ingrained.
Yeah, that's right. That'd be my take absolutely as well. Is that if you got the habit of working from home and it was only for a few weeks here and there in Sydney, you're like, oh, I'll keep working. Whereas if you're like, no, I've been there for months. And they're like, oh, we really need the office. Come on, man. You dealt with me for months, not in the office.
Yeah. Here's the longevity of the impact in Melbourne compared to Sydney. And remember, Melbourne had 5 kilometre rules. You couldn't drive, you couldn't do anything. Whereas a lot of people in Sydney still even went to the office, right? It was just not locked down anywhere near the extent of Melbourne.
And I think to your point, they've just got so used to working from home now that it's becoming the norm.
Yeah.
Right? And that's what they're used to. They're like, well, actually, you survived while I wasn't in the office. Why do I need to come back in? But I think what a lot of people are missing is that the office creates an immense amount of opportunity, not only from a career-based perspective, but also from a learning perspective, from a knowledge sharing perspective, and from a culture. Right, your ability to have the bantering and looking each other in the eye is very different than over Zoom, right? Like you've got to be able to do those type of things.
Look, I get that. I just worry that if you're a 23-year-old or a 24-year-old, you're like, mate, old man, I'm not interested.
Oh, totally.
Happy career, buddy.
Right.
I'll take my hour and a half back each morning and each night, and
and a recession will sort that out.
Exactly.
Right.
Yeah.
So, if unemployment goes up and the 23, 24-year-old who just wants to sit by the beach and do his work from home, he might be forced all of a sudden to.
But that's not saving. That's saving the property market later. Like, I guess what saying, you might be right, but what's going to happen? It'll have to get worse before it gets better. If you're an inner city landlord going, I just need somebody to come in, hopefully they're going to stop working from home. It's like, well, recession first, which means you haven't got anyone in yet, and no signs of it. And then on the other side of it, they might. Well, not different to me. Anyway, so otherwise,
there's obviously pros and cons to each side of the story. Working from home, better family, work-life balance.
Sam with his home office in the background.
Yeah, with my 10-second commute from the house to the office. So, I'm loving working from home. And we've got another question from Ryan. It's a similar sort of structural change that came out of COVID. And he's asking what the panel's view on household formation, how that's going to affect demand sort of now and over the medium term, say the next 5 to 10 years. Have you guys got some views on that?
Let me start with mine, because I've probably said it a few times here. I guess the way I look at household formation is I think there's this underlying, there's an underlying demographic of, people prefer to live in a house by themselves or with their family or whatever. And the more money they get, the more it's like, maybe I need 2 houses or 3 houses or whatever it is. So there's an underlying thing about people going, I'd like to live spread out more. And then there's this economic imperative over the top of it, which is I can't afford to have 3 houses, and so I've only got 1. And I can't afford to have only 1 flatmate, and so I've got 2 flatmates. And so in the short term, it's the economics that override it, and in the long term, it's the demographics. And so I guess I look at the next 5 years and go, well, no, I don't know. I think it's going to get worse before it gets better, I suppose. I think everyone's tried to spread out during the pandemic. Is actually that part about I want to live with fewer people has become more significant during the pandemic, and there is a structural change. But we're just running into this economic problem now that you might not see that trend come out for a few years, I suppose. Anyway,
I don't disagree with you, and I think even that the regional locations that have obviously boomed because people want more space and they want a bigger house and all these sort of things, they are all based on the current model that we're living in as well. A lot of it is based on being able to work from home, so you can move out to a different location. So I think it's very dependent on where the future heads and what changes, right? Because that will bring people back in, and then the tightening of budgets will also change people's dynamic on do they need X amount of houses, do they need a flatmate with them or not. It's extremely dependent on how the economics play out.
I mean, and that's that part with the regional, isn't it? Where you look at, pick your regional city of
Ballarat and stuff.
And you go, actually, these guys just have oodles of space around. There's actually nothing really stopping, putting in a few thousand people here and there. But we haven't yet. And so it's sort of that. I mean, are you seeing a building boom in that, or
we don't see that really in that space. I don't think there really is a big building boom out in those regions. But I think it will come. But they have massive, obviously, property increases in those regional areas, and a lot of it would, arguably be unsustainable given the growth that they've had in certain areas. No different to you look at the prices of houses in the peninsula. Everyone all of a sudden, all the capital that was there, everyone wanted to get out of Melbourne. I'm going to buy a holiday house. Property prices went absolutely nuts. The converse market, those prices will come off, right? Because all of a sudden, no, you know what, I don't need that as much. It's a nice thing to have. The first thing that went crazy in the GFC was everyone was selling their boats, right? So, you've got to get rid of these things that you just don't arguably need. And look, regional stuff went through the roof. My biggest worry of regional assets that went up was that if you don't really have a workforce in some of those regional towns to support the income levels that a lot of those people are on, if they are working from home type arrangements, if something fundamentally changes to that, for instance, banks happen to say, you know what, we need a chunk of you back. That's going to put pressure on them because they can't exactly go into town and get a job on similar money. Right. So then it's going to be, do I stay in Ballarat? Do I not? Well, we've got a staff member that moved out there as well. It's like, no, it's just too much. Right. So certain things do change.
And I think also, we haven't had immigration for the last 2.5 years, right? And the immigration, when they're coming from an Asian community, tend to live in an apartment block, right? So they will come in, and those apartments that are actually vacant will be filled, and those people who are there going, actually, I want to go to something bigger, it creates that cycle where people go, hey, I want to go back to a house. You know, I'm not saying, you know, anything special, but within my budget, that's what I can afford. And you'll notice that cycle will start to evolve over time.
Yeah.
We need immigration to build our economy, right? And we've had it stopped for so many years.
Yeah. Okay. So I think there's a whole path of immigration. I'm not going to run over that can of worms, but what we will go to is the development side, because you know, that we obviously had a huge pipeline of apartments that sort of all coming to a conclusion now, just as everyone wants to have a house in the suburbs. What are you seeing in terms of that development market for I guess, let's start with the residential, all the apartments that are sort of just finishing in Sydney, Melbourne, Brisbane?
Yeah, so look, I guess we aren't, so we don't get involved in the development lending. We see a lot of it obviously out there.
Yeah.
There's a lot of pressure on being able to get development finance, right? So that's one clear issue that's been in the market for some time, but definitely got harder during COVID. In order to get a development loan through a major, you know, you need to have reputational with them. You need to have a certain builder on your project. They are extremely tight on giving out development money. Yeah. So then you have the second tier space that grew dramatically in that world, thanks to the banks tightening up. And they were then, again, they're choosing really the bank quality.
And sorry, now we're talking, so this isn't the apartment, so this is more talking the residential.
On a generalised funding of developments, right? Yeah. So you had these second tiers that were then becoming funding bank type transactions.
Yeah.
And then the whole market blew up, as we alluded to before, with this liquidity. A lot of new lenders in our sort of world, this is what we call maybe the third tier, then grew their businesses off the back of funding developments. Yeah. And the only way you can do that is if the second tiers aren't willing to bank that developer, is what is the type of developer you're lending to. Now, a lot of them are still pretty good and they just want to turn around a lot faster. So that solves why they're paying more for their money. But also there's other developers that are just a little bit more risky and they're taking a higher LVR against those sorts of assets. So we saw a massive growth there. The part that we see now coming through our books and inquiry, even though we don't do it, is a lot of incomplete type developments that are coming through. We're also going to start seeing some residual stock. I think will go up because they're not going to be able to unload.
Okay, so let's do the incomplete first before we get so incomplete because the
cost overruns. Cost overruns. So you're getting a lot of projects that are lockup, but they now need another $500 or $1 million to get finished. The incumbent lender can't lend anymore. Valuation's cooled off. And so they're stuck in a.
So take 500 to $1 million. I'm assuming we're talking about an apartment now, or are we talking about?
Oh, we're talking sort of maybe five townhouses for us. So we don't, to be completely, we don't see the guys that are building 1,000 units, right? We're not in that world. That's really sort of more your max cap sort of space, and the big guys that are doing $100 million plus loans. Where our zone is looking at the $0 to $20 million space, which is generally your 20 sort of apartments or your 5 or something like that. So that's really the stuff that we see on market, and there's a lot of pressure on that. You're also seeing, just a massive amount of apartments, even the luxurious type apartment stock development, especially in an area, say Brighton, right? Yeah. Massive amount of development on one major street there. And we've seen certain deals recycle through one default at a lender to another lender to going to another lender. All that's doing is the equity slowly being eroded, and everyone's just hoping they get the right valuation to do a deal. But that market as well with apartments is pretty much now on hold. Like, it's very difficult to sell because it's a glut. Everything's coming on the market. They're all pretty good, but they're also all wanting, prices from a year ago, and it's just not happening. So it's going to be interesting to see the good developers that have got good backing will be able to hold. They'll do a residual stock type transaction. They'll sit on them and slowly sell them down, or they'll lease them out. I think the worry now is that sort of smaller tier developer who has leveraged themselves through the nose, and they're coming unstuck with costs. There's no margin in these things. If you started building, 2021 or late 2020, and you're not finished, all that margin you thought you had has been eroded by property. The property price now coming off a bit, and also your costs. There's zero left in it for you. So I think we're going to see a lot of pain there, and we do see numerous deals that come across that, and other ones are only the other week where they're actually raising investor capital in their own created way to top up the 70 or 80% loan they're looking for. So, and there's so much liquidity out there, they'll probably find the investors. So it's an interesting space. It's my view.
interesting sounds like dangerous. It would be another way.
If not done right.
But
the caveat, there are good lenders out there that assess them really well, and they lend to the right developers, and they manage them. But you've got to manage them, you know, on the ball. You know, we know certain lawyers that act in this space, and they've got a lot of defaults on development. The thing is, they're not realising it because they can't. They're reliant on that developer trying to find his way out. Because if the lender steps in, the whole thing's going to blow up. So it's going to be an interesting 2023.
Yes. Yeah. Well, and then the message for, I guess, for investors is, if you hear about this great deal where you just need to tip a few $100,000 in so this guy can get a loan to finish off his development, is
due diligence. Yeah.
First answer should probably be no.
Yeah. I think you know, everyone can get blinded by the return, and you need to not be. Right? There are good operators out there, even ones that do development funding, that will provide a you know, as safe a sort of proposal as they can. Smaller shops that are doing stuff, you've got to be very, very mindful of the outrageous interest rate offers that are out.
Well, yeah, that's right. And you're not talking about a 7% return on your money.
No,
you want to be north of that.
You want to be north of 20. I think.
Yeah.
That's okay. The development, the Chinese developers, they largely disappeared until all the big ones turned up and put a few on. They seem to be finishing the projects.
Yeah, look, again, I think that market come the closure during COVID quietened it down. Right, naturally, you've got the owners, you know, for extremely large developers that are still doing stuff. But in our world, we haven't seen as many, I guess, sort of Chinese developers that were doing a lot of stuff at Box Hill Way and all this sort of stuff. You're not seeing the same level of all that was active. You're not even seeing them generally in that, just in the borrower landscape that we get. Whereas previously, I couldn't give you a percentage, but definitely allocated a high percentage of our borrowers that they do now. And they're always that they had, you know, 5 or 6 assets or some residual stuff from a development they finished. And they're always quite active. They're very active in buying new sites and doing different things. We're not really seeing that at the moment. The demographic of the loans we're seeing now is, you know, there are either opportunities to settle a purchase that they've got, and getting money through a bank is so difficult that they're left to last minute. And they come to us and go, oh, I thought my bank was going to fund me. I've now got 5 days.
Right.
So we get a lot of that sort of stuff, especially, you know, they're buying a commercial asset and they need to turn it around, or they need to pay out something that's going on. Well, they want to hold an asset, you know, that residual stock, or they want to refinance, get some cash out to keep going. So we're not so much seeing, I guess, that Chinese demographic at the moment.
Yeah. And do you think the flood of, so we spoke about the flood of property. I'm right in saying there is a flood coming on at the moment of all these projects that were started pre-COVID and are just sort of finishing up now. But there's not a lot of demand for apartments. So do you feel as if, I guess anecdotally, I guess I sort of feel as if its developers are still like, yeah, I'll just keep leaking out a few here and there just to keep, I don't want to push the price down too far. But
if they can.
Yeah, they can, yeah. But none of them are really in the phase that, we're not just getting to the phase where people there's nothing to go, I just need to dump them, get whatever, I'll take whatever I can. We're not at that phase yet.
No, we're nowhere near that. And I think that is, though, goes to my point where lenders, even though they know that their borrowers are in technical default, they're working with them. Yeah. Because they know the only way they get out is for that borrower to slowly trickle his way and deal with it and get out. But if they get involved, then they're going to look at a mass sale. But there's definitely, the market is affected. There's, you know, some large sites, well-known sites that we've seen valuations on that were bought in 2019, you know, for 8 figures, and they're coming in 20% under on belt now when they're ready to settle. Yeah. So these things are, you know, that shows you where the market's heading. There's a lot of opportunity. There's a lot of stock out there that if you're spending even 2 mil, 3 mil, 5 mil on an apartment, you've got a plethora of things to choose from. Yeah. So that does help you then drive down a bit of price.
Yeah. And do you think the high-end market is affected more than the middle, the bottom tier at the moment? Or
you got a view on that?
Well, look, for me, I think it because of percentages, it'll impact them heavily.
Right.
Just through
a waste of money.
Right. Yeah. But when it comes down to it, what we're noticing in there's a lot of demand in those areas because those people who are opportunistic buyers are realizing, hey, there's a bargain over down in Brighton that I wasn't able to get previously.
Right.
You know, if you were trying to buy in Brighton kind of at the end of 2021, right, where it was peaking, whereas it's now slightly down. So there are opportunistic buyers who are turning around saying, you know what, I am aware that we're in a cycle and I know that I missed out on this part of the cycle and it's coming down. So it's equal in value that they're expecting to pay. And they know the cycle's going to happen. and they're investing for their future. So those where there are houses in a luxury market will probably be a lot easier from a selling perspective, whereas those that are in the apartment block, because no one wants to sit inside it, and especially if you're from Melbourne, as Stephen mentioned, we were in a shoebox for all of our life kind of thing for 2.5 years, you're not going to want to go back to that. So I think the luxury market in the right place for the right area will always be popular. Anything that's around the water will always be a popular world. And obviously when you're in Sydney, that's prime real estate. It doesn't matter whether you're in any form of cycle, right? The hardest ones will be on the outskirts where you're talking around the newly developed regions where, large scale construction and estates are going up. They're going to obviously feel it a little harder.
Yeah. And I think the people with money still have money, right? We haven't seen that occur in our economy yet. It's a lot of wealth, still lots of money going around. And you've seen numerous, through the news, there's numerous articles of high-end assets that have traded extremely well. So I think people with money have got money. They don't need to sell. And if someone's got that much capital and they want it, they'll pay for it. So I think we're going to see more pressure in the 500 grand to sort of 2.5 mil world than what we will see pressure points elsewhere. But if that market does cool naturally, based on the percentages, the numbers drop is bigger. But I just think the general person is going to be affected more in the current world.
And you'll see it more. It might appear on the front page. Somebody sells their place that might have been 900,000 for 600,000. Everyone's like, again, where somebody sells something for, was going to be 30 million and they sold it for 20 million. It's like,
correct.
Just lost 10 million.
Big numbers.
It's like same percentage, but
correct, precisely. But I think what we're talking with the current pressures in the market is going to affect a lower, not even lower level, still 500 grand to 3 mil borrowers. I think will be more affected than the other. Until if it affects businesses, then it starts to be a problem. But we have to wait and see.
Right. Anything else? We've taken heaps of your time. Really. Anything else I missed? Is there anything big that?
You can have some closing statements, and then I'll say something.
Well, just from me, I suppose your viewers are they're smart people, right? Like, and it's a matter of if it doesn't smell right. If it doesn't smell right, then chances are question it. Okay. And all we encourage people to do is that in hard times, people will still yearn for the same level of yield. But always back yourself on selecting a reliable brand, reliable company that has a track record and is centered around values that you also align with, right? There will be smoke and mirrors, and we know that.
Well, and can I add a little bit in terms of that? Like, if you're in the property area, because I've got a reasonable amount in the property in prior lives, I don't do much at the moment, but people will generally, if there's a reasonable amount of risk, you want 20 to 30% returns plus. And then working it down. So it's the most danger comes when you think you're getting an 8 or 9% yield. You say, that sounds pretty good, but actually you're taking risks that everyone else wants 20% return on. That's the real danger one. So so I guess if you don't know that much about property, get advice.
Yes,
absolutely.
Fundamentally for you, and that's key, right? Getting advice so you can understand not only as an investor, where does property and in our space, a debt fund, where does that sit in your portfolio, right? Because diversifying your portfolio on an investment basis, investments 101. And making sure you've got a reliable brand that helps you have a regular level of income, if that's what you're looking for, then select that. If you're looking for something that has your capital growth, then you'll be selecting something slightly different, right? It's about making sure you've done your due diligence, understand what it all is. And look, the fundamental thing that we talk about is just pick the phone up. Pick the phone up to the organization. Don't just rely on a website. Pick the phone up and ask to speak to the most senior person in that area. And if you get through to them and you're able to understand it, but do due diligence, just not do it on face value. Because we've noticed a lot of people who are coming to us saying, my friend over here is getting 12s. And I'm like, if your friend's getting 12 on a residential property in Kew, I'm a bit worried for your friend, but I can't give them advice. And I'd say, just make sure you understand where it fits to your portfolio, what your long-term strategy is, because it'll have peaks and troughs in the property market, and you will have people saying it's going to fall by 30%, but they didn't realize it went up by 20% in the last kind of quarter. So understand the noise and also make sure you get financial advice, but fundamentally select something that you have as a brand. Brand you trust. It's paramount, because at the end of the day, those that have been around for over a decade are still going to, no doubt, be over there for a longer period of time. That's how I look at it.
Yeah, hopefully 15 years, that gets you past the GFC.
Well, if you can say you've been through the GFC and you know how you dealt with certain activities, and you know what the lending requirements were, what was done in the property market, you've got the scars and you know what not to do. Whereas those people who are looking through rose-colored glasses, trying to start new funds and saying, I can deliver this, but the risk return is here. I mean, we're always skeptical about that.
I guess that's what I saw. My prior business to Oak was around pre-GFC, and you saw a lot of the market that you're starting to see now, right? So it's just a matter of being cautious. You've got to keep moving, and the fundamentals are extremely solid, right? But we're going to see an interesting market moving forward and how much it cools and etc. But we just take a cautious approach to everything, and you're better off playing the long game than the short game and making X here, but then potentially losing it. So we just keep doing what we do every single day.
Thanks, really appreciate you guys coming in.
Thank you, Dan.
Yeah, that's sound advice, guys. So now we've got our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So this week's a little bit different. So we're asking our viewers to tell us your real-world property anecdote that's currently unfolding. So feel free to post your stories and engage with us and some of our other viewers over the coming days. So Damo, I'll just quickly hand back to you.
I want to hear one from the last month, Sam. Not interested in your 3 year ago one. I want to know what's going on right now.
Yeah, what's happening right now. So yeah, Damo, I'll hand back to you for the investment implications just quickly, and then Stephen will give you a quick opportunity to talk about Oak.
Yeah, sure thing. So look, I mean, on the investment side, I'll be really quick because we've just the performance report we've got up that sort of runs through a lot of what we're looking at. But I think from this perspective, with that property front, it's sort of similar to the company earnings, how we're looking at it, is that we're concerned that we're headed for a troubled time. And we're not quite sure. All the early warning signs are there for a whole bunch of these measures. And that's why we're trying to get guys like this on to sort of see what's happening at the front. We're not there yet in terms of big downturns in earnings and big downturns in terms of bankruptcies and things like that. But there is a whole bunch of signs that you've got to be concerned about. And so it's not time to sort of head for the hills yet, but you certainly want to be quite conservative in your asset allocation, and that's where we are. And we've been sort of since the start of the year, and so it's really about trying to manage that and look for these early warning signs that are actually telling us, yes, we were right, and we are headed for more trouble, or maybe no, and it's the bird's back on again. But for the moment, we're still very much playing it as there's lots of things to be concerned about. We're sort of selling into rallies and then picking up a little bit and switching around. But we're still not yet at the phase where we think everything's bottomed and it's all heading back up again from here.
Excellent. Nice one, Damo. And Stephen, just quickly, if you'd like to tell the viewers a little bit about how they can get in touch with Oak Capital, or just a bit of info if you'd like.
Yeah, sure. So look, Oak Capital is an alternative non-bank lender and a credit fund. So if you're an investor looking for a responsible, reasonable yield on your money backed by Australian property, then please feel free to reach out to us to have a conversation. Reach out to oakcapital.com.au and one of our investment team will give them a call and have a conversation. So it's probably the best way forward.
Fantastic. So just want to say thank you very much, Stephen, Troy. Super informative insights at the coalface. So we look forward to having you on again next time.
Thanks very much.
Thanks very much, Sam.
And Damo, as always, thanks for putting on the great show. And we'll talk to you next week.
Thanks, Sam.
Thank you.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with myself. Don't forget to like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of articles and videos in addition to this podcast, so that's where you can see all that content there. And of course, you can also follow us on all major social media. So from myself, Damien, Stephen, Troy, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.